Dear learners, welcome to the course on Essentials of Financial Management. Today, I shall be starting a new unit that is devoted to capital busting technique. Friends, we have already shared with you that every finance manager has to take three important decisions. The financing decision, where he has to decide where from to raise fund in what amount. Secondly, he has to take the decision regarding where to invest this fund and in what amount. And thirdly, dividend decision, where the decision regarding distribution of dividend and retention of profit has to be taken. The investment decision is further divided into two parts, the long term investment decision and short term investment decision. The long term decision is known as the capital busting decision. So, this unit shall be devoted to the concept of capital busting, importance of capital busting, stages in capital busting process, classification of projects under capital busting, decision making criteria, and also how to calculate the cash flow would be discussed in today's lecture. So, starting with the concept of capital busting. Capital busting is nothing but a process of evaluating, selecting and prioritizing long term investment projects that achieve the goal of owner's wealth maximization. So, whenever a decision has to be taken with regard to the long term investments like investment in plant and machinery, investment in land and building, investment in furniture and fixtures, in all these decisions the careful planning has to be done with regard to the selection of projects, so that the owner's investment and owner's wealth is maximized. If we talk about the features of investment decision, here it accepts the exchange of current funds for the future benefit. That means, whatever investment is made today is expected to give return over a period of time. It involves significant capital outlay. Since it is a fixed asset investment, here the amount of investment is going to be very large, and also the funds are invested in long term assets. Future benefits will occur to firm over a series of years. So, this investment is not there only for one accounting year or 2-3 years, rather it would fetch a return for next 5, 10 or 15 years. These investment align with the firm's strategic goals and maximize shareholders value. So, this long term decision is actually setting the direction for long term growth of any business organization. When the business is going to allocate funds, now the projects such as acquiring fixed assets, upgrading existing facilities or expanding operations would come under the purview of capital busting. Now, what next? The purpose of capital busting projects include whether the firm is going to expand, either the firm is going to replace its old asset with a new one, it is going to diversify in some other areas. So, all will come under the head of capital busting technique. So, capital busting decision is a very important decision, as a very important steps. If it is taken wrongly, then naturally it may lead to the financial distress or even bankruptcy to the firm. So, longer the horizon and longer the uncertainty associated with the capital busting decision, and this uncertainty may emanate from the factor like the uncertainty of cash flow, cash inflow and outflow, the life cycle of a product, economic condition at large, cost of capital and also the technological changes. Now, here it is important to distinguish between the capital expenditure and also the revenue expenditure. Capital expenditure, it is the expenditure where benefits extending beyond 1 year, such as purchasing machinery, constructing buildings or conducting research and development activities, whereas operating expenditure includes the short term expenditure where the benefit would be realized within a year. Suppose you invest in some kind of production of raw material and you are paying for wages or cost of material, it would be referred as the operating expenditure. Now, why the capital busting is so important? As we have already seen, it is a long term decision involving huge investment outlay, and more importantly all these decisions are irreversible. That means, if it is once decided by the company to invest in long term assets, it cannot be withdrawn. It can be withdrawn, but the cost of withdrawing this decision is going to be immense for any company. That is how the importance of capital budgeting can be ascertained. The another point that reflects the significance of this decision includes optimal resource allocation. We understand the funds are very scarce. So, that is how whenever we are going to select a project, it has to be done in a very stringent planned manner, so that every resource allocated results in the optimal benefit for the company. It is also going to affect not just the short term, but the long term profitability of the company. The risk management is also associated with the capital budgeting, where a project which is not viable should never be selected. So, rather focus should be on selecting all the profitable projects in hand. Wealth maximization is a concept which says that every investment today should result in a greater amount of wealth created for the shareholder. It would also have a control over the expenditure, and if the decision is taken with regard to the long term asset investment, naturally simultaneously the next question arises, from where these fundings are going to come. So, this is actually providing a guideline for choosing the different sources of fund, long term or the short term. Evaluation of alternative is another significant aspect of this decision, where the discounted and non-discounted techniques are there to help a finance manager. Now, the capital budgeting process will pass through different stages, because here it is not one time procedure. So, starting with the number of alternative proposals are generated, and thereafter the estimated cash inflow and outflow are compared, and finally the required rate of return, that is the cost of capital, is also calculated in order to match whether the return is more or the cost is more, so as to arrive at the final decision. So, after completing all these steps, only the projects are finally selected. So, these are the stages in capital budgeting, which starts with finding out the different alternative, evaluating them and selecting the best alternative out of the bouquet. Now, here capital budgeting projects may be of different type. Now, the basis can be the freedom of selection, and also the whether it is going to diversify its business, or it is going to replace the old asset with a new one. So, investment proposal which is classified on the basis of freedom of selection is actually consists of three important type of decision. The number one is mutually exclusive investment proposal. As the name is suggesting, here the selection of one project is resulting in the rejection of the other project. That means both the projects or so many projects are competing with each other, and selection of one would definitely be the reason for rejection of the other projects. The second category indicates that independent investment proposals can be there, which includes all such investment proposals which is being considered for performing different jobs of the organization, like investment in machinery, automobile, parking lots, recreation centers and so on. And these are all the independent projects where acceptance of each of these is done on its merit without depending on the merit of the other project. That means they are all independent and they are not competing with one another. The third category indicates the contingent nature of the investment proposal. Contingent or the complementary investment proposal refers to a condition where the selection of one project indicates or it makes it necessary the selection of the other projects. So, that means certain projects which will be selected and their selection is contingent upon the presence of other projects. So, that is how the projects under capital budgeting can be categorized based on whether the management is free to choose simultaneously or selection of one would result in rejection of the other projects. Now, the long term investment proposals can also be categorized on the basis of their nature. So, number one projects can be the project related to expansion. Here the company would like to add more capacity to expand the existing operations. So, then it is called the expansion projects. The expansion in a new business or a new product is called the diversification projects, whereas if there is a project which is going to improve the operational efficiency or it is going to reduce the cost, will be kept under the category of replacement and modernization projects. So, these are the different classification based on whether the company is selecting all the projects simultaneously or it is bound to select only one project. Similarly, it can also decide whether the nature of expansion, diversification or replacement is going to be the resultant outcome of the investment proposal. Now, here in order to help the management, there are number of techniques. There are a few techniques which is used by the management under the condition of certainty, where the cash flow, the cost of capital and the other parameters can be ascertained with great amount of accuracy. This is called the project under the certainty. There are certain projects where the cash flows, the cost of capital cannot be ascertained with great amount of accuracy. So, we have got different set of proposals, we have got different set of techniques for that. But every technique should fulfill the following criteria. So, number 1, every good technique should consider the time value of money. What is time value of money? We all know that the money received today is better than the money received tomorrow. So, when I am going to receive some amount of profit after 1 year, after say 10 years or 5 years, then the future cash flow should not be taken at their face value. They should be rather discounted to their present value and then it is compared with the initial outlay to find out whether the project is viable, project is feasible, it is worth selecting or not. So, time value of money is actually going to make the cash inflow and cash outflow on an identical parameter. The second criteria that makes any technique a good technique or foolproof technique is that it should not consider the profit as a criteria, rather it should be based on the cash flows. Why cash flow or why not accounting profit? It is a matter of discussion, but here the accounting profit suffers from so many limitations of accounting, where as the cash flow is going to eliminate all the limitations of accounting profit. For example, accounting profit is a historical figure. It do not reflect the price level changes and sometimes it is also a biased decision which has so many elements of subjectivity. Then the firm's cost of capital is known as the discount rate, which should be used for selecting a viable project. Then it should consider all cash flow to determine profitability. When we will discuss the techniques, we would discuss some of the techniques like the payback period method, which is just interested to find out the period within which cash inflows are recovered. So, any cash flow after the payback period, it is not considered to be an important variable for selecting the projects. Then the capital budgeting technique should help in ranking the projects according to their true profitability, and here comes the role of discounted cash flow, and it is the NPV, IRR method and PI method which falls under the criteria of finding out the true profitability of the projects. Now, every good technique should also recognize the fact that bigger the cash flow, they are better than the smaller ones, and any cash flow received at earlier stage is better than the cash flow received at a later stage. Now, here this should also be as good as that it should be used in choosing the mutually exclusive projects. So, these are the criteria. Later on we will see how what techniques is going to be qualified as a good technique on these criteria. Before we enter into the other discussions, as we have just mentioned that profit and cash flow, these are the two things, but cash flow should be preferred over the accounting profit. So, now the question arises, how to convert the profit into cash flow. So, profit can be sales minus all the direct and the indirect expenditure. So, but the procedure for calculating the cash flow starts with the earning before depreciation and taxes. Suppose there is a firm, so EBIT is 20,000. So, from this we have to deduct the depreciation. Say if it is 5,000, so earning before taxes comes out to be 15,000. Then taxes at a rate of 50% comes out to be 7,500. So, leaving only 7,500 in the hand of the management as earning after taxes. So, this 7,500 is nothing but the accounting profit, where we have deducted depreciation and the taxes as well. But if we have to consider cash flow, this accounting profit has to be converted into the figure of cash flow. So, how to convert this? This magic can be done by adding back the depreciation in the earning after taxes. Why we are adding back the depreciation? Now, it will not be out of purview to discuss the nature of depreciation. Let me tell you friends, here depreciation is not a cost. For ascertaining the accounting profit, we definitely deduct the depreciation, but when we have to calculate the cash flow, it is added back, because depreciation is an amount which is kept aside just for making it possible to replace the old asset with a new one. So, it is the accounting treatment fund is not moving, it is not given to any outside party. So, cash remains in the company. So, that is how it has to be added back in order to find out the figure of cash flow. I hope you are clear how the profit is calculated, that is the sales minus direct and indirect expenditure minus depreciation minus taxes or any other financial cost like the interest, and once we have arrived at a figure of earning after tax, adding back the depreciation would give us the figure of cash flow. I hope it is clear to everyone. Now, we will see how the initial cash flows are calculated. Initial cash flow is also referred as the initial cash outlay. That means, the amount of investment company is making today in order to receive a series of benefit in the future year. So, here this process starts with cost of the asset. So, here the asset that we want to purchase, the cost of this is the first stage towards finding out the initial cash outlay. Now, if there is certain installation cost, it has to be added in the cost of asset. Now, if the company is going to take the replacement decision, that means old asset is going to be replaced with a new one. So, old asset would be sold out in the market. So, any consideration received by selling the asset will be deducted from the cost of the asset plus the installation cost, because this is something which is flowing in, it is not moving out of the company. Then any increase in working capital, maybe in the form of cash, sundry debtor, all these stocks would be added, because it is a cash outflow, and tax liability on account of capital gain on the sale of goods would be adjusted in order to finding out the final figure of initial cash outflow. Here what is tax liability? Like suppose if the book value is lesser than the market value when the asset is being sold it out in the market, then company is having capital gain, and on this capital gain company is expected to pay taxes, and if the market value is lesser than the book value, it is resulting in capital loss, and then taxes would be saved on this capital gain. So, this was the first stage. Second is calculating cash inflows, like once the investment have been made in certain equipment, certain plant and machinery, now it would be giving sales, and thereby the cash flow would also be generated from the project. So, how to calculate the cash inflows? Let us see the process. Here profit after tax is the initial stage, and adding back the depreciation and any financial charges like the interest would also be added into it, and if there is any cost incurred on the repair or there is any additional investment in plant and machinery or in some fixed assets, all these have to be adjusted in to find out the cash inflows. And when the project is coming to an end, uh, again there are certain cash which will be released. So, the annual cash flow of the last year of the projects along with any working capital that is being released and also the scrap value of the plant would also be added to the annual cash flow. This is called the terminal cash flow. So, here the terminal cash flow along with the annual cash flows of all the years would be considered as the cash inflows from the project. And finally, this cash inflows and the initial cash outlay would be compared in order to find out whether the project should be selected or it should be rejected. Now, there are certain methods for evaluating investment proposals for risk free projects. Then all these techniques can be segregated into two parts. One is called the non-discounted cash flow techniques. What is non-discounted cash flow techniques? Here we do not convert the future cash flow to its present value, and that is how it is named as non-discounted cash flow technique. So, if anything is received after 1 year, now the same absolute value will be compared against the initial outlay, and under this technique we have got two very important elementary techniques of capital budgeting. One is called the accounting rate of return and other one is the payback period method. Now, we can briefly discuss what is accounting rate of return. It is also called the average rate of return. So, here the income received from the project, income here refers to again the accounting profit received from the projects would be averaged out. So, average income upon the average investment. So, average investment here refers to the initial investment and the ending investment divided by 2. So, average income upon average investment multiplied by 100 gives us the accounting rate of return or the average rate of return. Here the income that we received in subsequent year after making the investment is not discounted, it is not converted to the present value. That is how it is known as the non-discounted cash flow technique. We will later on discuss all the merits and the demerits of this particular technique. Let me briefly also point out what is payback period method. Now, as the name is suggesting, payback period method refers to a process or technique whereby company is trying to find out the number of years within which the initial investments are recovered. So, here if the project is generating say 5,000 for next 5 years, right, and the initial investment is 10,000. So, it is very easy to calculate the payback period method. So, first year 5,000, next year 5,000. So, within 2 years company is going to recover the initial investment. That is how the payback period method is very helpful in deciding the quality of the project. So, any projects having lower payback period method would be preferred over the projects having a higher payback period method. Now, the second category of the project technique is referred as discounted cash flow technique. Discounted cash flow, it is very well following the principle of time value of money. You know, a bird in hand is better than 2 in bush. So, any money received today is better than the money received tomorrow. Let me give you one very small example here. So, suppose if the company earns rupees 100 on 1st January of any year, or it is going to earn the same 100 rupees towards the end of the year, say on 31st December. So, there is a time lag of 365 days. So, if the 100 rupees received on 1st January is investment and the rate of return is say 10%. So, now this 100 rupees will become 110 rupees on 31st of December, which is not possible if the rupees 100 is received on 31st December. So, this is called the principle of time value of money. So, and this principle actually force every company to put all efforts so that the money is received as early as possible. So, under this we have net present value method where the the future cash flows are converted to the present value, and then they are compared to the initial investment, and the difference between the two is known as the net present value, and this term is very important because this is called the wealth of the project. This is also called the value of the projects. Then there is another technique which is called the internal rate of return method. Here again we are using the principle of discounting, but this internal rate of return method is a rate which equates the present value of future cash flow inflows with the initial cash outlay. That means, at this return the NPV is going to be 0, and profitability index is a refined method over the net present value, because it may be a case where there are two firms having the identical net present value, but if the size of investment is different, naturally the profitability index is going to be different for the two projects. So, here it is relating the initial investment and its size with the future cash flows, and any index better than 1 is going to tell us the quality of the project. So, any projects giving the profitability index as more than 1 should be selected. So, these are the discussions about the conceptual framework of capital budgeting. Here we have seen that this technique is a process where we not only identify, but we also evaluate, select and prioritize the project that has to be chosen by the management. Then we have seen the different kind of projects based on the freedom of selection that the management enjoys, and also on the basis of the nature of the long term investment. Then we have seen what should be the criteria of telling whether the technique or the criteria for selecting the project is good, it is going to maximize the value of the shareholders or not. And then we have also devoted few discussions on the methods for evaluating the investment projects, especially in context of the risk free projects. This is all with the introduction about the capital budgeting techniques. So, with this we come to an end. Thank you so much.